High-risk investment. Trading on margin carries a high level of risk and may not be suitable for all investors. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with trading and seek advice from an independent financial advisor if you have any doubts. Market opinions. Any opinions, news, research, analyses, prices, or other information contained on this video is provided as general market commentary and does not constitute investment advice. MasterTheMarkets will not accept liability for any loss or damage, including without limitation to any loss of profit, which may arise directly or indirectly from use of or reliance on such information.
Video.
Let me see.
Yeah, I can hear
All
you
right,
now.
traders, there we go. Good. I just had that muted up. Now we're all good to go. We have an amazing lineup of a speaker today for you on our live trading workshop today. And just to give you an overview of the live trading workshop, its purpose is to give you the truth of trading by interviewing top traders who trade for real and give you different perspectives to trade the markets on the smart money framework. Today's speaker is Lawrence Bensdorp. He's the founder and CEO of Trading Mastery School and has been making a risk-adjusted return of more than 5 times the S&P 500 since 2007. After traveling the world, coaching whitewater rafting guides, and starting and selling his own adventure tourism company, Lawrence was hired to manage a small boutique venture capital company in the Netherlands and found his passion trading and beating the markets. Over years of analysis, Lawrence developed automated algorithm-driven trading platforms that combine psychology, technical analysis, statistics, and position sizing principles to maximize profit and keep management time to virtually zero. Lawrence, such a pleasure to have you on the show today.
Likewise, a pleasure to be here.
Great. I've been very much looking forward to this interview. Firstly, I think one of the things that really caught on to me, because we look a lot at quantified trading systems and everything, and especially when you told me that you manage 55 trading systems, that really caught my attention. Wow, I've not really heard that much before. So I was really looking forward to this. Before we get into the nitty-gritties and all of that, just give us a little bit for the viewers listening in as well, a little bit about a background about you. How old were you when you started trading? What event kind of triggered your interest and all of that?
So I started back in 2000 when I was in the Netherlands and I was helping my family business out, which was a venture capital investment business. And a part of that was the stock trading investments as well that they had. And I saw that every banker over there was basically doing the wrong thing that they could possibly do, because that started in April 2000. So the big boom market of the dot-com boom was just over and everything started to drop. And it was my task to really focus on the risk management part. And I said, like, okay, I see all those people over here at the banks, big, expensive buildings and everything. And they were just telling me things like, okay, Lawrence, we should hold on to the portfolio. It always gets back to break even and stuff like that. And after I did some analysis, I said, like, well, okay, but there are times where it can take like 7 or 10 years until it gets back to break even. So there's no guarantee. Or do you have any guarantee from me that it will go up? And of course they didn't. And that eventually made me decide, like, okay, I need to take things into my own hands. And that's where my passion for trading really started.
Interesting, isn't it? How life actually brings us to where we really need to be and what we love to do. Interesting that over here, I think everybody says this, isn't it, Lawrence? That the best person to look after the money is yourself, right? And
oh, absolutely. Yep.
Exactly, and nice, amazing story. And over there, life pushed you to take control and then to learn this, and then it became your passion as well. Very, very interesting story. Thanks for sharing that. I mean,
and I had no idea about trading. I had no background in trading or anything. I had a completely different background. So it was a long road, but absolutely well worth it. But I wouldn't have expected that before I entered in that world that it would end up like this. Absolutely not. Yeah.
Oh, wow. I mean, out of interest, what was your background before you got into all of this then? Lawrence?
I started to work as a whitewater rafting guide in summer, and in winter I
Okay.
was a ski instructor. So, which was a wonderful time when you're very young to do those kind of jobs. At that time, it gave me the opportunity to actually travel around the world already and living in different countries, and working on whitewater rafting on different rivers in different continents and stuff like that. So it was a complete different background. Yeah.
Interesting. Oh, wow. Thanks for sharing that. Yeah, I mean, in the rivers and nature and oceans, now you've come into the big ocean of the market universe, isn't it?
That's certainly also a wild ocean, but in a very different way. Yes.
Yeah, true. I mean, going into a little bit on overview side of questions before we then break it down into strategy, entry, stop loss, and all of that. Just a little bit of overview. I mean, I really loved reading your book. It was amazing, well laid out, very clear. Thanks for doing that. I know it must have taken you a lot of time to write that book, but amazing. I'll talk a lot about it
Thank
later
you.
on as well. Yeah. I mean, in there, you do, of course, I mean, you did mention that your main style is automated trading. I mean, what is your main driver for becoming an automated trader? Was it mainly towards a lifestyle choice, or was it to remove emotions, or a combination, or something else?
Um, I think it's a combination of different things. I think first of all, I don't want to sit behind the screen the whole day. Um, I don't think that is something that I would like to do for the rest of my life. And so that is number one. And I think another thing is, to a certain extent, it does take away the emotion of your trading, that you do not need to look at it. That does not mean that it takes it away completely, because you are still the one who actually can turn off the button of the computer and say, like, okay, I'm not going to trade today because this or that. So it helps, but it's still, you need to have the right mental state and the right mental framework, basically, to make sure that you actually can trade what you have developed as well. And that's when you get more into risk management and position sizing and stuff like that, which I'm sure you have questions on later on.
Yeah, absolutely. And I was touching a little bit on the emotions, but we'll go a bit deeper into that in the psychology section, because quite a little bit of a misconception is automated trading, emotions. Come on, why would you think about emotions? But we'll come to that later on, right? Which we
Perfect.
spoke a little bit on. Now, 55 systems right now. That's quite a lot to design and to monitor. Before we come into the concept of the systems, you talk a lot about objectives, and interesting, when I was reading that, oh wow, fine. I mean, there's someone out there who thinks also like similar to me, because when I talk to my clients, I always say start off with concept and objective for your strategy. It's the same principle
Right.
for any business as well, right? Think about your objective. What do you want to achieve? So, in that sense, actually, Lawrence, what is the main objective with all of the systems you actually create? Is it mainly finally to achieve the main objective of best return to risk-adjusted returns, or something else?
That is one of the objectives, yes, but also that it is a blend of styles of systems that suit my personality as well, and that are not dependent on what the market does. So to me, I don't really care what the S&P 500 does, because I trade both long and short at the same time. I do have other systems as well that trade more on different sectors, that trade more on different asset classes and stuff like that. So for me, it's all about long-term wealth growth, and wealth increase, basically, and doing that without a lot of effort. Now, when I said that without a lot of effort, there was a huge amount of effort that I needed to put into to get where I am right now until everything is running on autopilot with 55 different strategies, of course.
Yeah, it must definitely have taken you a very long time and perseverance and all of that, which we will come to it in a bit. But as an overview, your main categorization for the systems, as I saw in the book, were trending systems and reversion systems. Is that right? Or maybe you want to elaborate a bit more further on that. That'd be great.
Yeah, I think that's fairly accurate. We can say, okay, we have systems where we just follow a trend, and then we have other systems where we basically do a sort of counter trend style, where we, on the long side, we buy the fear, and once it has reverted to its mean, we sell it again. And then you can split that up into long systems and short systems. You can also add then another layer where you have a lot of different asset classes. As far as commodities, for example, I don't trade any mean reversion, but only trend following. But I do trade them both on the long and on the short sides.
Ah, interesting. Okay. And some of the thinking behind the systems, right, that you display in the book, very well anticipated, because one philosophy is that counter for all the what if scenarios that can happen so that you can be at peace and all the systems have taken care of. Now, that's how every professional should be doing, but sometimes we are not able to think ahead or anticipate that. How did you come up with these concepts? Was it through experience or talking to those annoying people that you had mentioned, which actually Ray Dalio talks about that actually as well, which he says, talk to people who are more intelligent than you, that who can really refute your system and see the weaknesses of it so that you build it strong. So was it really mainly to talking to people, or was it just through your own trading experience that you were able to build and think of all these ideas?
Yeah, in my case, it was through my own trading experience,
Mhm.
where I mean, the first 4 years or so, I was just losing money. Then after that, it was kind of flat, and then after that, I really got into the systematic approach, but I was really geared towards only mean reversion. So I started the systematic trading approach in 2007. I had 4 systems, 2 long and 2 short.
Right.
And so it was only mean reversion, which really suited at that time my style, my personality very well. So to get in a trade fast and get out fairly fast, short trade duration was very comfortable way to trade for me. That did incredibly well when I started with it, but then there came a time where it didn't do that well anymore. And then I started to analyze, okay, like what is missing over here? And that's when I started to kind of naturally expand on those 4 systems, adding
Right.
other systems that would do well in those different market environments. So when mean reversion wasn't doing that well, certain trend following approaches were doing incredibly well. And when you blend those together, then you see that the risk adjusted return of your strategy and your simulations is actually increasing. You also, from a conceptual standpoint of view, see that, okay, there is a better edge in here. And then it was easier for me to say, like, okay, I can easily expand more on this and add more different systems for different market environments. And that was all with the objective, of course, to have such a big blend of a suite of systems that kind of is not depending on what the market does anymore. It just does its own thing. So right now, markets have been fairly favorable for the last few years. But if they go down, to me, it wouldn't be having a big effect, because then my other short selling systems would jump in.
Got you. It absolutely makes sense. So this thing whole comes from your own personal trading experience. Interesting. Have you ever thought of getting people who are even bigger and more intelligent than yourself to come and look at the systems and then be one of those annoying people that you talk about?
So, I mean, I've always looked I mean, I read the books like Market Wizards and stuff like that, and so there were those amazing trend followers in there that I really looked up to, and then I found other styles like mean reversion. That's how I then started. But what I think would happen over time is, especially with an automated approach and a systematic approach where you run back tests and everything, you need to be incredibly careful that you're not fooling yourself by over optimizing your
Yeah.
system. Currently, the computer power is a lot stronger than it was back then in 2007. Back then, when I ran 4 strategies on 7,000 stocks, one backtest run would take me about 24 hours, and praying that my computer wouldn't completely freeze and would need to start again. Right now, I have 55 systems, and a simulation takes like 15 minutes, basically. So it's a complete different thing right now. But the annoying people to me are the ones that I want to have looking over my head, imagining like, okay, I develop something and I need to convince that the strategy that I made, that it is robust, that it actually works, that it actually does what it is supposed to be doing, and that it is not over optimized. Now, when you only have yourself, it is very easy to kind of fall in love with the back test that you see. You see that wonderful 45-degree angle, and then you say like, okay, this is wonderful, this is perfect, and you feel very good and proud of yourself. Now, how good would it be if you send those rules to somebody else, for example, and say, hey, try to break this, try to critique me on this, or just have an imaginary person who is always looking to the back of you, like, okay, what are you doing? Or even a harder one is, for example, that you say, okay, I need to present my strategy to 1,000 very annoying but smart people that would like to invest with me, although I do not invest money for other people, but just imaginary. And then you need to explain that strategy. You get all kinds of annoying but good and smart questions. Now, if you can't answer those questions about your system, then most likely there is something wrong with your system.
Very, very nicely said. I think some people always feel a bit uncomfortable, isn't it? I mean, as you would have known, Lawrence, it's just, they feel like their ego gets hit when somebody is actually critiquing them or they can't answer it. But actually, they should see the other way. They're actually helping them grow even more stronger in anything in life.
Yeah, and it's not really critique. It's actually for your own best, because what you want is you want to end up with something that is not only looking great on paper, but actually gives you the live returns that you're after.
Exactly, absolutely. Now, moving on from the overview to a little bit on the entry side of things. I mean, what does your typical trade entry look like? I mean, I was reading your book. It was mainly on percentage entries of previous closes and moving averages. Is that how you usually enter? And what was the main reason why you chose that to be your entry triggers?
First of all, there's one thing. I think all trading approaches need to be simple. But then secondly, it depends a little bit of the approach, because um, my entries are completely different, whether it is a long-term trend following system, whether it is a long mean reversion system, whether it is a short mean reversion system, or whether it is a short trend following system. So would you like me to get into each of them, for example?
Yeah, just maybe just as a generic, maybe
Yeah.
example, maybe take two of them. That'd be great.
So let's stick to the long side then for now. So on the long side, trend following, the main thing you want is to look for a trend, and you can use the closing price for that. So you say, I want the close of the stock to be above the 200-day exponential moving average. That measures a trend. Then you can ask yourself, what is your objective? If you want to be early in the trend, you would use a 20-day or a 40-day. If you want to be very late in the trend, you want to have like a longer term look back. That defines a little bit more your trade frequency as well. And basically, the only thing you want to do is measure a trend to say, okay, from this point and looking back 30 days ago or 100 days ago or 200 days ago, the market is trending up. And then all you want to do is enter and ride that trend. You will have a stop loss in there. And that's the main concept. And what I've seen so often is that people make it incredibly complex, come up with a lot of rules or a very fancy mathematical formula, but eventually it all does the same thing. You measure if the trend is up, and you know that the reliability of that trend following system in general is less than 50%. Because you cut your losses short, you let your winners run. So your winning trade is your average winning trade is a lot larger than your average losing trade. Because every time you get more into a loss, boom, you get out. So that is the simple trend following approach. The mean reversion approach is where we basically say we want to buy something when it has reverted to its mean. And we could do that, for example, within an uptrend. So we say the close of the stock is above the 100-day moving average. That shows an uptrend. Then we say the 4-day RSI is below 15. That shows that there is actually a pullback to the downside. Then we enter the next day on a limit order that could be 3, 4, 5% below the previous close. So we want to buy when the fear is there, but also when the statistical likelihood that the stock will revert to its mean within a few days is more than 50%. That is what you're looking for. So you get in, you place a stop loss then, and then you wait until it reverts to its mean. And that could be with a profit target like 5%, 3%. It could be one average to range. But you just want something that it shows that it reverted to its mean, and then you get out.
Got you.
Those kind of trades are a lot faster. The expectancy per trade is a lot lower. So you need a lot of trades to actually make it worthwhile to trade a strategy like that. Because on average, maybe you make 0.3, 0.4, 0.5% per trade or something. So if you only have 20 trades per year, it doesn't really help you enough.
Yes. So that was the ones that you started off trading, right? The mean reversion to get it quick and to exit, and then you expanded it on the trend following systems. Just so that the viewers get an understanding, and sometimes people get a bit confused on it. But I will just share my screen over here, just to understand a little bit on what would you consider a reversion to the mean. So let me just share this screen over here. If the boys can put that onto out there, that's good. I think they'll be able to see it. So I've got something here. So when we talk about mean reversion, of course, in your example of that, so you got your mean, which I've mentioned here. Let's say just a moving average, right? We've identified that as the mean. So whenever it goes below that, you are looking to trade it back to its mean, right? Is that right?
Yeah, correct. Yep, exactly.
And in terms of price action way, you don't look at it in terms, you don't look at the trend in terms from a price action perspective, right? For example, some people who define swing lows and all would say, okay, in price action way, this is a downtrend, but I'm still trading it back to the mean. Or in this case here, you would say that this is an uptrend in terms of price action because of the swing highs being higher and you're still trading it back to the mean. If I'm not wrong, you don't look at price action based trends. Is that right?
I mean, I certainly do look at trends on a longer term base, but for the mean reversion, I look for something that on a shorter term base is on the long side oversold. So that's that first point that you pointed out, where it reverted, where it really got below that moving average, basically.
Yeah,
So if you go lower, yeah. So at the lower part over there, that's where it really got oversold.
got
And
you.
then you say, okay, this, but I like to generally have that the longer term trend is up as well. So you don't see that in this chart. But let's
More like this.
assume, for example, yes, exactly. Yeah.
Got you. That was one question I always had, isn't it? I mean, if you add one more layer of that, I thought there's a more higher chance of it reverting to the mean when you're in alignment with the trend as well. And
Yeah, I do like to most of them on the long side. It depends a little bit on the objective of the strategy as
got
well.
you.
But for my long stock trading strategies, I like to know that the longer term trend is up, so you're actually in a little bit more bull territory. Let's put it that way. And then you look for those snapbacks where the market snaps back. There's a little bit fear in there, so you just buy it lower and then it reverts back to its mean and you sell it again. And especially when I was younger, it was a style that really resonated a lot with me. Um, I was a lot more impatient when I was young. And
Oh yeah,
then a style like
yeah.
that where you have
Tell us
a,
all about it, right, Lawrence? Yes,
it's
impatience.
yeah, it's you know, and it goes with time, and that's I think the wonderful thing with trading as well, that it can teach you a lot about your personality, and you know, it really tells you a lot. And if you're an impatient person, that will show up in your trading. So this really suited to me very well when I started to trade this in 2007.
Interesting. Yeah, there's always that element. It always brings us all memories. Whenever you're young, you always want it fast. We are impatient, but then less life teaches you and trading teaches you. You
Yep,
need to always be aware of the P word, right? The patience, and then you start to
absolutely, yeah.
you start to evolve. Coming on onto the next question, I wanted to. I saw a lot of ranking in your trades mentioned in the book as well.
Mhm.
So ranking might relate to probability scoring, and some traders might mention that it affects the robustness of a trading system. What would your opinion be on that?
So in my case, the objective of the ranking is a little bit different, and we can go into probability after that. But I trade baskets of 7,000 stocks, but my position sizing only allows me per strategy to trade 10 stocks. Now, the markets as a whole sometimes can get quite correlated. So there will be times when there's like a lot of stocks that are in an uptrend, and then the market sells up. So I get a lot more than 10. I could get 50 candidates that I could trade for tomorrow. But my rules from my money management say I can only trade 10 stocks. So then I need to choose like what 10 stocks to trade. And that's where the ranking comes in, or you could call it a priority as well, that you give priority
Right.
to a stock that is the most oversold or stock that is the most volatile, for example. So that is the main objective that I have rankings in there. If I would trade only one symbol, no ranking, of course. So it's more because it's large portfolios of stocks. Now, it is important that one needs to understand if you have 100 or 200 candidates and you can only choose 10 of them, that the impact of the ranking can be quite significant. So you do need to be careful that you do not hugely over optimize and find the perfect ranking in there. So if you choose, for example, what I always like to say is like, okay, you need to have a ranking that conceptually also makes sense to you. On a mean reversion part, I say like, okay, I want to trade the stocks that are the most hammered. So that could be the ranking could be the lowest rate of change over the last 3 days. With trend following, maybe you want to have a ranking that you want to be in the biggest uptrending stocks. And you use the last 100 or 200 days percentile return of the stock. So that needs to make sense. But then if 200 days works well, 180 days, 190, 210 and 220 need to be working fairly similar as well. If not, I would start to question it a lot. And even if you go back to 150 days, 120 days or something, it still should have that edge in there.
Interesting. Yeah. Thanks for explaining that on how to see the best way of ranking them. So that was that's important.
Yep.
Coming on to long trend high momentum. So one of the systems you had mentioned was long trend high momentum, and you used the highest rate of change, which you just mentioned over the last 200 days. Why that number? Is that what was proved best in the testing that you did?
No, not really. There's no magic in any number. It doesn't exist. It might exist in the simulation that you run, but that is not to say that the future will be the same. But it was more like, okay, this is 200 trading days. It's a round and equal number, which is like what is like 3/4 of a year or something like that, and that's it. But there's no real magic to it. It's more like that you say, okay, I want to have a stock that over the longer term has had significant momentum, which would be very different if you'd say I trade a strategy that has the highest rate of change over the last 20 days. But I do have a strategy like that as well, for example. So it really depends on what you're after. And my philosophy is more that you need to have a lot of different strategies, especially if you trade on a large basket of stocks like I do, because there are times where a 200-day look back will work a lot better than a 20-day look back, for example.
So that's one of the main reasons why you chose 200. I mean, if you were to go, why not 150? Why 200? What would the reason be where one chooses one over the other, even though you're saying that it's not the magic number and it couldn't really be the biggest factor for reproducibility? Then what is the determining factor for choosing one over the other number?
Time frame. So I think there's a difference if you look for stocks that had momentum over the last 20 days or stocks that had momentum over the last 200 days. The same goes for trend. If you look for a trend over the last 20 days, you look for stocks that you can get in a trend a lot earlier than when you have a look back over the last 200 days. And those both can have pros and cons. So it's not that I advocate, okay, 200 days is a magic number or anything. That's the one that I use in my book, for example, in one of the systems. But in my own trading, I have systems that have a 20-day look back, a 50-day look back, a 100-day look back, 150, 200, 252, so that you kind of have a blend of different look backs combining all into one suite of systems.
Interesting. Yeah. Okay, that's good. I think it's the blending that is the key that the audience needs to take away rather than the one
Yeah,
exact.
and maybe a comment on that. So, for example, if you have a trend following system on the S&P 500, if you have a look back of 200 days,
Mhm.
and you are in 2019, so you're riding that trend of the bull market in 2019, right?
Mhm.
Then 2020 comes and COVID comes. So the S&P 500 needed to drop quite a bit until it was below the 200-day moving average, right? When
Mhm.
it got short then. But it already dropped quite a bit because it's such a long look back of that trend. Now, what if you have a system that has a look back of 20 days? It might have been a little bit more choppy in 2019, but when you had that fast sell-off in 2020 in March, February, March, during COVID, you would have been in very fast, making a lot of money to the downside. So somebody who has a trend following strategy with a shorter term look back would have done incredibly well in 2020 because they caught the trend to the downside very fast, but also it moved up very fast after that. We all know how fast the recovery came in 2020, and then you would have gotten long again very fast again. Now, if you have a longer term look back, it wouldn't have been working that well during 2020, but better in large extended bull markets, for example. You see the difference?
Absolutely. Yeah, that was very well explained. That absolutely now makes sense. Totally. Thanks for explaining that. And the reversion sell-off, I think, yes, you mentioned that. Just a quick thing before we go into stop loss and risk management. I mean, do you scale into trades at all? And if yes or no, why?
Now, on a single strategy, I don't, because I trade 55 strategies. But in a certain way, I actually do. Let's put trend following here as an example again. With mean reversion, there's no scaling in. There's no sense of scaling into a mean reversion system because the trade duration is too slow. But if you have a trend following style, you start to have your systems with a shorter term look back of 20 days, they are getting in the earliest. Then they get another system in that has a 50-day look back. And then the next one gets in is a 100-day look back. So that is kind of a form of scaling in, but it's not based on individual system. It is based as the blend, basically.
Nice. Good. Thank you for that. Now, moving on to stop loss and risk management and drawdowns and all of that. I've read the book, but just for the viewers, I'll ask you the question. Do you use stops in the book? You did mention that some traders and some trading systems show that without a stop, you can actually do much better. And why have you adopted or not adopted the stop approach?
So for me personally, no matter what my back test is, I like to have an exit point to know that when I exit there, what the amount is that I will lose from my total equity. And even sometimes you have strategies that on simulation level look better than with or without a stop than with a stop. Imagine the following scenario. You test back from, you have data from 1990 to 2024. And you're buying a stock when it has been going down 2 days in a row. So it reverted, it was a little bit oversold, right?
Mhm.
Maybe that would have been doing a very good in your back test. Now, what if you take 1987 into that back test? what happened in 1987? There was the crash of the market, where the market dropped 20% and lots of stocks dropped a lot more over there. So if you at that time had stop losses or at least some kind of protection, then you have a way of getting out and protecting your equity. The largest drawdown is always in the future.
Mhm.
And what I don't want to end up with is not having stops, and some kind of black swan for my system happens that basically causes it to getting close to ruin. So that's why I say I always want to have stop losses. I think it's a lot better.
Great. Maybe you're definitely in the same camp as that. Yes, we do
Yeah.
like our stops in place. Now, you mentioned in the book that the stops are mainly placed on volatility based, and usually you're using ATR range. Is there a main reason, Lawrence, that you've used X ATR? Usually you use 2 or 4 ATR. Why did you choose that particular X times ATR? Was it
That
from
was
testing that you did, or?
No, not really. That was in my book. I don't think there is specific magic to average to range. You can use the percentage stop as well. The only thing that I like about average to range is that you can adjust your positions according to the volatility of the stock. So that is why I like that. But it's not that if you would, let's say with a mean reversion system, you want to have quite a wide stop loss because you need to give that trade some space. So instead of 2 average to range, you could also use maybe a 15% stop loss, for example, and your testing results would be fairly equal. So there's no real magic in that. And I do have strategies as well, for example, that say on the trend following part, where I trade a basket of commodities, and when it's below the 150-day Keltner channel minus 2 average to range, I get out. That could also be a stop loss, for example.
Got you. And how do you find those levels? Is from the testing on which creates the best risk-adjusted returns? Is that how you're determining it?
It starts with the objective. You need to first know what you want out of your system. So if you want a system that creates asymmetrical return,
Hmm.
meaning you risk a tiny amount and you look for those big outliers, you're going to want to have a small stop loss. On the other hand, if you want a system with a lower trade frequency where it follows the major trends, you don't want it to get whipsawed a lot, then you don't want to have a small stop loss because you get stopped out more frequently. And then you say, well, maybe you do a 15 or a 20% stop loss. So it really depends on what, first of all, the objective is.
Hmm.
If you have clarity about that, then you can move to the next step. Okay, you want to have a small stop loss. Would that be a percentage stop loss, or would that be an average to range stop loss, for example? Or would it be a shorter term moving average as your exit point as well? That could also be the case. So it really depends what you look for. And as I said, I have all kinds of those. I have systems with small stop losses, the systems that are in for a very long term. I mean, if I trade a penny stock system, I can't have a very small stop loss because those stocks go up and down a lot, and you're just hunting for that big outlier, but you need to give it a little bit of space, for example.
Exactly. I understand. Yeah. It's always nice how you tie it back to the objective, which is what I tell all the clients. Lock in the objective and then work backwards to meet in alignment with your objective. So thanks for sharing that.
I
Why
think
I did
go
sorry,
ahead.
Lawrence.
No, I think if you focus on objectives and you really think what you want from your strategy, it will probably save you 80% of backtesting time. and development.
Yeah, totally agree. This is what I tell all the different programmers, kind of clients who come through to us as well. Absolutely. Why not use, as I was reading your book, you did mention quite a lot on ATR levels and percentage-based stops and all that. Do you use technical levels to place your stop, like behind moving averages, Fibonacci's, support resistance lines, and all of those kind of things?
No Fibonacci. Um, Support resistance, you kind of can define that sometimes by a Donchian channel.
Mhm.
Technical exit, you can define as well as a Donchian channel or a Keltner channel or a Bollinger Band. So I do use those as well, actually. Yes.
Oh, so you do. Okay, yeah. Just because I just
Yep.
thought when I'm reading in the book, I was a bit, oh, okay. It's generally using that.
Yeah,
Thanks.
that's only a tiny part of what I'm doing, of course.
Great. Okay. Thanks for sharing that. Um, and your trailing stops, I guess they're also a combination, right? Volatility stops as well as technical level behind stops, right?
Yep. Absolutely, and it could be a percentage as well on stock sometimes that you just say, okay, I'm in a stock, it's trending, and I just trail it with a 20% trailing stop, for example. Eventually, on the trend following part, you're just looking for two things. You want to enter a stock that is in an uptrend, and you want to exit it when the trend bends, and then you get out. And whether that is measured by an average to range that is trailing it, by a moving average or an exponential moving average that is trailing it, or by a percentage or whatever, um, the objective is fairly similar with those different indicators, actually.
Got you. Okay. Got that. And the trend changes how you usually trail a stop. This is very good. It's very nice and clear. Coming on to risk management, which is very important. You do talk, so, okay, yeah, we will ask this question first. What would you say, in your opinion, is the goal of risk management? Is it to stay in the game till you get to the big winners, or is it to reduce the drawdown and improve your risk-adjusted returns, or is it a combination or totally something else?
Yeah, I think it's a combination, and it's more about actually making sure that you trade with a position sizing algorithm that is within your risk tolerance.
Mm,
So a trader will spend more of his life in drawdown than they have equity highs. So you want to make sure that when you're in those drawdowns, and let's call that for now the pain zone, you want to make sure that those drawdowns are within your tolerance that you can handle and not freaking out and suspending your system because in dollar terms, you lose too much. And when do people suspend their system? They always do that at the worst possible time when they're in their largest drawdown. Now, if you accept the fact that you will be in drawdowns, then you want to make sure that you size your position in such a way that even if your drawdown is coming to twice as large as your back-tested drawdown, that you will still stay in the game and
mm,
continue to trade as long as you have the confidence that there is nothing wrong with your strategies. Because often what I've seen is that people actually suspend a system or a suite of systems without that there is anything wrong with the system at all, but they can't handle the pain of the drawdown of the dollar amounts that they have lost, and they just say, okay, I quit. And that is just because they are trading too aggressive. And I see that so often, and I can't emphasize enough on it. I mean, it's wonderful to read stories of people who made consistently like 100% per year and stuff like that. And you have outliers like that that could happen for a short period of time. But generally, that means that you trade quite aggressively as well. Like for example, the turtles back in the 80s. who got very, very famous because they made huge returns. One of the reasons is they made such big returns because their position sizing was very aggressive. They had, I think, one of their largest drawdowns of one of the turtles that I spoke to was around 70% during that
Correct.
time.
Yeah, that's what my memory also says. Yes, about 70%. You're
Yeah.
right.
Well, I wouldn't be able to handle a 70% drop in my personal account. I would say, okay, this is just too much. Now I need to make what 300% to get back to break even. My goodness, not my thing.
Absolutely. I think it's very important, I guess. I mean, it's kind of a bit counterintuitive, isn't it? I mean, we all as traders know that as professionals that the first thing you must always keep thinking of is risk tolerance, drawdowns, and all of that. In fact, it's a bit different to most professions, isn't it? You're thinking about losing and losses before you even think about winning and success. So yeah, but it's such an important point. Thanks for doing that.
Yeah, and I always say to everybody, like, I mean, you first need to be a risk manager. That's your first task
Yeah.
of being a trader. Because no matter how good of a strategy you are, if your position sizing is too aggressive, the risk of screwing it up just because your mental state cannot handle the pain anymore is a lot larger than when you say, okay, I put the position sizing at only half, but you depend more on the law of compounding.
Absolutely. I think
And
that's what the usual saying goes, isn't it? I mean, look after the risk and the upside will look after itself.
yep, exactly, exactly. And I mean, my position sizing was a lot more aggressive when I started trading, and when I started to become profitable as well, it was a lot more aggressive. I was a lot younger, of course. I had a lot less capital. So if you have a 30% drawdown on $100,000, it's not the same as if your money is in the millions. And then I think it is important that you say, like, okay, you want to aim maybe for a lower compounded annual growth rate, but therefore say, like, okay, if you make 15% per year, that still equals to every 4.7 or 4.8 years to double your money. But it's all about that consistency, that you don't suspend something that has a significant edge.
Makes absolutely sense. Also, another thing, that comes to my mind actually, Lawrence, is filling the potholes, right? When we talk about risk
Ah,
management, right? And Tom Basso actually talks about this as well in our
mhm.
last interview that we spoke about. Would you say
Yep.
also this is a key kind of a concept in which how you also risk manage and look to reduce your risk to the returns? If you can say a few things, that'd be great to hear your opinions on this.
Although those potholes, which is basically the times that you are in a drawdown, um, I mean, you can lower that drawdown through risk management,
Mhm.
but let's assume this is a long only strategy, and it is because you see when it's losing money there in the bear markets in 2000 to 2003, and then again in 2008, it starts to be in a drawdown as well. So even if you lower the position sizing, your drawdown would be lower, but you would still have that hole in there. So what would you do over here? You would create strategies to completely offset that drawdown. So those strategies over there are having that drawdown on this equity curve
Mhm.
because the market went down. Now, if you simultaneously then trade a strategy that short stocks, then you really start to fill those potholes because those strategies are designed to make money when the long strategies are losing money. And that's how you combine those strategies. And that is the whole reason that I trade 55 different systems. And I'm happy to look for more systems as well and extending that as well if I see something that can help my suites.
Great. Okay, so that's good. Using the different strategies to fill the potholes rather than just thinking on one alignment of the risk management. On that,
No,
Lawrence,
it's key. It's key actually. Yeah? It's with risk management, you cannot fill the pothole. You can lower it, but you
yeah,
need to have another strategy to completely offset that drawdown in there. That's the whole idea of it.
nice, thanks. And then the other thing, which was when I was reading through your book, I was asking this question actually. I mean, you mentioned about diversifying with strategies, but not with different asset classes. What was there a reason for that, or was it just for the book? I wasn't a bit sure, so it'd be great to listen your.
Yeah, I think the book was focused on stock trading only. So in my own strategies, I do trade commodities long and short as well, and I think it's a phenomenal way to diversify your strategies a lot more. I mean, there's time where there's significant trends in the commodity markets, whether it's energy, agriculture, metals, or crypto as well, both long and short, by the way. So at the time of speaking, I'm long gold, I'm long crypto, and yeah, but that is a great way to diversify as well. So the book was focused only on stocks, but you can certainly use or ETFs that track a certain asset class like gold or whatever, or if you're more advanced, using futures for that as well.
Brilliant. Yeah, so that's good. Thanks for clarifying that. I mean, yeah, I mean, on a side note, amazing big bull run on the crypto, wasn't it? It's just it just never
Yep.
stops. In terms of rebalancing portfolio stock rotation, do you do that yourself?
I mean, every new position rebalances it according to my total equity.
Right.
I do not rebalance individual strategies because I trade so many.
Mhm. Okay, good. Um, that was good. I think that yes, this question here, in terms of risk management, drawdown, stop losses, and all of that, is there any particular trait that has taught you the biggest lesson?
Probably very early when I started to trade futures back in 2000 on a $30,000 account. And I thought at that time that it was fairly reasonable to make $100,000 a year and living off my trading income. And that turned out to be not the case. And I think I remember one day where I lost probably 30 or 35% of my account or something. So in dollar terms, it wasn't a lot because it was a small account. But so it wasn't one trade, but it was a cluster of huge amounts of screw ups in every possible way because I didn't know what I was doing.
Right. Okay. Yeah. And that taught you to revisit the whole concepts and become who you are today, actually.
Yeah, and that really taught me about risk management as well. It taught me about stop losses. It taught me about making sure to stay in the game and to make sure that you take
Nice.
care of your equity. Because it all looks nice when you make a projection that you're going to make every year 100%. But realistically, having a little bit more patience and making sure that you trade something that actually has an edge, but still maintaining your position sizing into a range that is according to your risk tolerance, that's a lot better way to live.
Nice. This part in the book where you talk about the S&P and the way you really represented the drawdown and recovery period. I found this really amazing, and I think it was one of the
Yep.
very well laid out points. In fact, I was referencing it in the annual summit that we just had as well. And it'd be great to hear from yourself, from the horse's mouth itself, on some of the points that you had made on S&P, especially in terms of drawdown and the recovery period and how people should really anticipate that and manage their expectations. It'd be great to hear your opinions on all of this.
As far as what to expect from your own system, you mean?
Yeah, especially in terms, you see, one of the things that I think traders oversee, I think, Lawrence, is actually the recovery period. They don't really even take that into
Yep.
consideration. And especially as you
Yeah.
and in back testing, this is generated to you over a couple of hours, but they don't put themselves in that space when how will it feel like 7 years in real time. So all those things, I think, how they should think about it and how they should look at recovery periods would be good to get your comments on that. Yeah.
Yeah, very, very accurate and very important points because um, many people eventually think like, okay, I just buy the S&P 500
Hmm.
and I'm gonna make 8% per year or whatever the number is. And even if you go back like 100 years or something, it's looks fairly accurate that you have that. But um, what you don't see in that part is the pain that you need to go through to get that 8%. So over here in this example, the longest drawdown period is from what is it, April 2000 to somewhere in 2007,
Hmm.
86 months. You then finally got out of first having lost half of your money. You made a new equity high, and then again your account dropped 56%.
Hmm.
And that one took another, what is it, 48
65
months or
months. Yeah,
something.
65 months. Yes. Yeah.
Exactly, yeah, 65, yeah, to get back to break even. Now you look at a chart like that, and then one could say like, well, um, as long as I know that the longer term I'm going to get 8%, I can do that. No, you can't, because if you're 4 or 5 years without making any money, the human being starts to look for the next best thing. So maybe there's something else I should do. Maybe it's crypto. Maybe it's gold. Maybe it's day trading. Whatever it is, but everything goes through longer and extended drawdowns. And the S&P 500, if you go back further, in 1929, it had a drawdown of 85 or 87%, the S&P 500. So it first had the crash of 1929, but the 2 or 3 subsequent years after that, it dropped even further. It took 25 years to get back to break even.
Mm.
So it's all great if you can buy that at the bottom, but if you start at the top and you suddenly lose 80% of your equity, people are not going to stick to that. So what you want to make sure is you want to have different strategies that make sure that focus to get that drawdown duration a lot shorter, of course. And in this case, something that would have helped over here is, of course, a short selling strategy, which would have made great money during those holes where the market was down.
That's the one that you reference in the book as the long-term trend following short and like a catastrophe hedge, right? Like
Yes, but also mean reversion shorts, but
mean
both,
reversion.
yeah. But they have a little bit of a different objective.
Yeah, and the catastrophe hedge, I think that was a really good point you made. I mean, even though many years it's not making any real returns and is net negative, but you need to have a system like that to counteract for black swan events, even like COVID and all of that, isn't it not? Yes?
Absolutely. So catastrophe hedge to me is basically to make sure that you have a hedge system in place that when all your long systems are losing money, your mean reversion short systems are not helping you enough, and the market keeps going down, that you have a strategy that when there's a real black swan time period, that you actually get short and capitalize on those huge bear markets like 2002 or 2000 to 2003, 2008, but also 1929, for example. And that strategy by itself is a losing strategy. So the compounded annual growth rate, and no matter what kind of catastrophe hedge you come up with, it can be you short the S&P 500 when it's below its 100-day exponential moving average, or 150-day, or below its 80-day downtrend channel, or whatever. They all get you in when there's really that catastrophe. And that is a time when all the other strategies are most of the times losing big time, so they can really help you to climb out of that. What you need to understand is a strategy like that has by itself a negative expectancy. So it is actually supposed to not make money in most years. When it's in bull market years or choppy years, it will definitely lose money or it's out of the market. But when you really need it, then it makes money for you. And that's the same as with a health insurance. A health insurance, you know that it's going to cost you every month X. But if you contract the good health insurance and you get a medical issue that really requires medical attention that can be incredibly expensive, then you know that what you are paying for, that premium, then you get the reward for that. So it's all about making sure that you come up with a healthcare plan that has the lowest premium and the highest possible service and best doctors that you can get. The same is true with trading. You want to look for something that has the lowest cost of the hedge, but has the highest rewards when there is a big catastrophic event. And then you can really capitalize on those events. And instead of losing money during that time, your accounts could actually be up. So then instead of climbing out of a 30% drawdown, you never are in that drawdown. You can continue to accumulate your money.
Brilliant. And I like your analogy about the health insurance premium. Yeah, that really puts it all into perspective. One last question on drawdown. So you've got all your backtesting results and everything. How much X multiple of your drawdown should you expect in going in real time in forward testing?
At least twice the tested drawdown. And that is if your systems are developed in a robust way.
Okay.
So if you have hugely over-optimized and just pushed the optimization button and came up with a phenomenal equity curve with 100% compounded annual growth rate and a 5% drawdown, then the strategy is not even valid. But let's say you have come up with something that has decent returns and a lower drawdown, you still want to at least expect that in live trading, your drawdown will be double that of what you have tested without doubting your system. So let's say you have tested a suite of 10 different systems and they have a 15% drawdown. You should be totally fine then when you are in a 30% drawdown, as long as you know that you have that everything is supposed to work as you have designed it to work. So that is the main thing that you want to have as your mental state, and that's how you need to position sizing as well, to calculate in such a way that, okay, if you have double the drawdown, you would lose X amount of your total equity. That would still maintain you in the game.
Interesting. Okay, good. Yeah, thanks for giving that nice detailed explanation there. I'm just thinking about time, so I'm just going to pick out just a few last questions before we wrap it up. Going into the last part, Lawrence, on target, on exit, do you have like a predefined target for all your trades, or do you have like an exit based on trading stop loss exits? How do you approach that, targets and exits?
It depends completely on the strategy. Trend following strategies, I have no targets. I just want to follow the trend until it bends. Mean reversion strategies, I do always have a profit target. And what you look for is just a technical measurement that it has reverted to its mean. So that could be a 4% profit. It could be 0.75 average true range over the last 10 days. It could be the close is above the 7-day exponential moving average. Something on the shorter term that says it has reverted to its mean. Vice versa when you're selling shorts.
Got you. And just a small question on that. The mean reversion you say has got targets. How do you decide that number? I know usually you use the profit at 4%. Why
No,
4?
not really. It's not. There's nothing magic about 4%.
Mhm.
4% just shows like, okay, that it has reverted to its mean,
Right.
but it should work as well on 5%. It should
Got
work
you.
as well on 3.5%. It should work as well when maybe the 4-day RSI is above 60. So it was very oversold, and then it reverted more into neutral territory again. So then you get out. So there's no real magic in that number or anything. And I think that is incredibly important for everybody to understand that there's no magic in any kind of strategy. And I think we could see that, for example, when the Turtles revealed their strategy, when it was finally revealed how they traded, it was kind of maybe for some people a little bit disappointing that it was such a simple breakout system. But eventually, what made them so much money is to stick to the strategy. But it was not that magic number of a 50-day breakouts on a Donchian channel. It wasn't anything magical about that. It could have been 35 days as well, or whatever.
Lawrence, in review of all of the above, a usual thing that comes in terms of strategy trading, quant systems, automated systems is when do you know you have tweaked enough? When do you know you have optimized enough on all these above parameters? What's the kind of litmus test that you use? Is it like, do I feel at peace now that I don't get any other kind of disturbances in my mind on the entry and exits, or what do you use as a reference point to know that you have tweaked enough? What's your performance indicators then?
It's a really good question, and it's probably even more important to understand that the more tweaking you do, the less useful it is. The main thing is that you have to have an objective of what your strategy is going to do. And there are two main things in there: when it is supposed to make money and when it is likely to lose money. Those are the main two things. So for trend following on the NASDAQ 100, for example, what do I want to see in my backtest? 1995 to 2000, I want to see huge return because it was the .com bull market, biggest bull market ever, I think. Those years you really want to see big returns.
Mm.
But then you also want to see the drawdowns that came starting April 2000 until somewhere in 2003.
Mm.
Because that's where the strategy started to give back all those profits and was stopped out. So that was a time where you have those drawdowns. If you don't see those drawdowns in there, then there's something wrong. Then you definitely know that you have optimized way too much. So if I develop a strategy on the NASDAQ 100, for example, and I get a 25% compounded annual growth rate, and I see at the same time a 50% drawdown, that to me means two things. Okay, it made money when it's really supposed to make money. So I'll look what it did from 1995 to 2000.
Mm.
It most likely had that drawdown in 2000 to 2003. Then it made money again until 2007. Then it lost money again, and so forth. So it is more that you look at your back test and say, okay, this strategy lost money in those periods. Was it likely to do that? If so, don't optimize, because you can maybe, with adding additional rules or tweaking the parameters, you can lower that drawdown to, let's say, 25%, right?
Mm-hmm.
Now, is that likely to continue in the future as well, where you're trading on a basket of stocks that is so volatile that you have the possibility of making, in some bull markets, to make 50% per year, that you then in down markets only lose 25% as a single strategy? I don't think so.
Great. I think that's a misconception. I used to do that mistake as well, because we tend to make that fit everything into that one strategy, whereas what we should be
I know.
about exactly is about creating another one, like what you're doing, blending all the systems to look at those points when rather than over tweaking it. And that was a brilliant reference point you gave, when is it supposed to make money and when is it to lose money, and is it behaving accordingly to that or not?
Exactly. And then understanding, okay, this is it for this strategy. And then you look for a next strategy that is making money when the previous strategy is losing money. That's the whole thing. And you combine the two then. That's the whole key. And if you'd see my 55 strategies, I think many people would be a little bit disappointed as far as the rules of many of my strategies. Um, it's not about the individual rules of the strategies. It's all about how they combine and how every strategy has its specific uh, objective of when to make money and when to lose money.
Brilliant. Yeah, thanks for sharing that. If there's any takeaway from here, I think the main takeaway that's really coming recurringly is the combination of different strategies and systems, which is what we have been telling our different clients. It's very nice to hear that from a very seasoned, experienced trader like yourself, reaffirming that as well. I'm just quickly going to skim through the psychology side. Really overshot quite a bit here, but I'm sure the viewers are really enjoying this. And
That's okay.
Lawrence, I must say one thing. When it's an amazing talk and a nice of sharing a point, time just flies.
I know, exactly. And I love that as well. I love talking about systematic trading, and there's not a lot of people in the world that like to talk about that. So I'm totally fine to continue. I think it's a wonderful conversation
Thank
with
you.
all the
Yes.
right questions.
On the psychology side, okay, so I'm going to ask you just two main questions here. Now, you did mention one thing is about drive and motivation. So you did mention for first 4 years you're not making money, and after 3 years a little bit, breaking even and all that. So 7 years you just kept going. What was the driver? Was it pure passion, determination? What was it? It'd be interesting to see. Was it to quit your job, or what was it really?
A huge desire to be completely independent and not relying on anybody else, but just myself.
Wow.
And also a desire to win into an arena that is incredibly competitive and hard, but also a passion for systematic or trading in general as well. To kind of solve the puzzle is something that that I really like to do. So it's a combination of those factors, but it was definitely the drive to have the freedom that I have created right now to trade 55 systems. Um, I don't really care what the market does. My systems do its own things. There will be times when I'm down. There will be times when I'm up. but over the long term, I have a good expectancy that I will be making a very nice return. And that creates for a lifestyle that I can decide to travel when I want, where I want, live where I want. I mean, I've lived in 12 different countries,
Wow.
and I'm currently in Argentina. I was last week. I was in Panama, and that's kind of the lifestyle I always wanted to have.
Brilliant. Very nice. Freedom of, they would say freedom of time, money, and location. That's exactly what you just mentioned. Absolutely. Yeah, another thing. Okay, so in backtesting automated systems, people do that. I mean, we're talking about this. I mean, people do the testing, what, 20, 24 years, 30 years of testing within hours, right? But whereas in real time, when you go through that drawdown, it's totally different. A lot of times, systematic traders feel like they just want to switch it off. They can't bear it, right? They can't bear that drawdown, which you mentioned a lot in the books. And it's so true because in real time, it's totally a different question because one day is 24 hours, right? So what would you say, in your experience, how was that before in the beginning days when you were a systematic trader, and how is it today? What was the difference and what was the journey like?
Um, I mean, when I started systematic trading, I think I definitely started at a time where it was very favorable for me. So
Nice.
2007 was good. Then 2008, I made a huge amount of money. Um, and I think that gave me the confidence that, okay, this approach is really good for me. Then there came times where where you say good trading is supposed to be boring.
Mm.
And that means that the excitement I have in developing new systems, in doing research, whatever it is, I really like that. But the trading process, I mean, with 55 systems, mine is, of course, completely systematized, 100% automated with my own in-house software. So otherwise, you can't do that manually. Of course, that's. I mean, you can, but the margin of error is a little bit too large in that.
Great. Okay, nice. It's amazing how you take all these adversities, but you take it as learning lessons and then you keep getting better and stronger. In fact, I think it's an important principle for being successful in any endeavor. It was good to hear that. One final thing on this is if you were to wind back the clock and go back in time, what would you do different?
Getting to know a lot earlier about systematic trading. That would be for me. It was amazing the first time I read about systematic trading that you actually can backtest something and have at least some proof of how the past of your strategy has been and if it actually has been making money. I mean, that gave me a huge amount of confidence because many people they trade a strategy or they think it's a strategy, but basically it isn't, and they don't really know what they can expect. But if I know what I can expect, then I have a great way to leverage on that, of course. So I would have wished that back in 2000, for example, I would have known already about systematic trading and backtesting and stuff like that.
Great. Okay. Not nice to hear that. Right.
On the
Great.
other hand,
Mhm.
I do think it is important to try to never look back to the past and always say like, okay, although I didn't have that in the past, I had those terrible experiences where I lost money all the time. I did all the bad things because they served as well as a fundamental base for my respect to risk management, for my respect to not over optimizing and stuff like that. So um, I think there's a lot of good feedback that you can get actually from the past. But if there's something said that I would wish I would like to have had, it would be that, yes.
Great. Yeah. I guess, when you look back, as Steve Jobs says, you can't connect the dots looking forward. You can only connect it looking backwards, isn't it? Every single event in our life, that there's a reason for it to build us to where we are, and also
Exactly.
lessons what we've come here to learn as well, isn't it? So,
Yeah, exactly. And it's, I mean, if I look back at everything that I did in my past, and all the screw ups that I had in my life, there's not one event where I say I look back at it from a standpoint of view of regret. No, it's all just feedback and say, like, okay, this is not something that I want to do in the future anymore. And that's the way that you can continue to learn, basically.
brilliant. Yeah. And I guess that's the mindset that has brought you to where you are today as well.
100%.
Incredibly impressive. Um, the final thing before we get into the speed round, where I'm just going to mention a few words and then you just tell me what comes to your mind, so that the audience will know the best place to get to know about you. I think there's two things, right? Lawrence, is your email is info@tradingmasteryschool.com. Is that right?
Correct? Yes.
Yeah, if the boys can, if the team at the back can just put that out on the YouTube channel and on Zoom as well. And then the other thing was, if they want to find out more about you, the website would be tradingsystems.com.
Yes, it's tradingsystems.com. That's the best place you can go. There's a free course you can get, but you can also find a lot more information over there. You can see the links of the books that I wrote, also the link of the book of my business partner. We offer mentoring over there for a small group of people, so you can take a look if that could be something for you. But I think that the free
If there are any pressing questions from the audience, yeah, you can type that in. But because we are run quite a lot of time, you can also email Lawrence also at the email address we've given. The final thing, Lawrence, I'm just going to mention just a word, and then whatever comes to your mind, you can just say in a few words what it means to you. So the first thing is I would look at is what comes to your mind if I talk about if I say perfection, what will come to your mind?
Mm, it can be the biggest limitation of success if you focus only on perfection.
Nice, I like that. And if I were to say success, what's the thing that comes to your mind?
Success to me means enjoying life at the fullest,
I like it.
living of my passive income, and making sure to contribute to society and help others.
Beautiful. And the final one, age. When I mentioned age,
I love an edge, and then you can capitalize. Then you can really leverage the edge.
nice, love it. Thank you so much for your time, Lawrence, and your patience. I know we've gone a bit off our usual time slot, but thank you so much for coming here. It
It's
was
my
such,
pleasure. Absolutely, it was a joy for me being here.
yeah, such a wonderful. I really enjoyed it as well. Audience, we believe that you've enjoyed it. Please do go and check out Lawrence's resources. Really, really incredible, amazing. The book, please do go and get it. It will definitely help you in designing your trading systems. I guess that's a wrap up from us for today. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.